Start your day with It's the Business. Here's Phil Dobbie.
Today, the FCA is worried that new investors are gambling on shares for all the wrong reasons and losing a lot of money in the process. But Rodney Hobson isn't too concerned.
People will learn. If people learn by losing money and they realise that this doesn't work for them, well, they've learned a valuable lesson in life. I'm sorry to sound a bit cold-hearted about it.
But what's the lesson for people who invested with Neil Woodford's now defunct fund and lost a lot of money in the process? That's a different story.
And I feel much more strongly about the people who thought they were making solid investments and now found that they were let down bodily by the regulator.
Plus, how much volatility are we seeing in the markets as Joe Biden starts to talk tough on China? Could it make Trump's trade spats seem like a walk in the park?
They have an overall goal to become the leading country in the world, the wealthiest country in the world, and the most powerful country in the world. That's not going to happen on my watch.
Well, China is testing in flying jets over Taiwan airspace over the weekend, and more geopolitics and technology. If you stick something in the cloud, you will make it a lot easier for people to hack it, whatever it is, even a live TV show.
The Weekend Today show off air this morning. It seemed like a glitch, but now the strong suspicion there is something more sinister behind it.
Yes, Channel 9 News in Australia off air yesterday. They say because of a Russian cyber attack. And even before that, media stocks taking a big hit last week, including the backer of Andrew Neil's new GB News channel, which incidentally will have all of its content in the cloud too. Oops. It's Monday, the 29th of March 2021. Good morning.
And now, it's the business, making sense of it all with Phil Dobbie.
Yes, how can it be that Amigo can launch a rescue plan for Neil Woodford's collapsed investment fund that will see less payments going to investors in the fund? They'll be capped while the company pays bonuses to its own executives. That's a question the Observer was asking yesterday, and we'll find out more about that this week. But also, we'll talk about that, plus a report from the FCA that there's a new breed of investor gambling on shares like never before. So should the FCA be doing something about that? Well, we'll talk about that with Rodney Hobson in just a moment, ahead of a week that should be fairly volatile in the share market. Well, just look at what happened in the US on Friday. Goldman Sachs sold off $10.5 billion, a massive block trade, and all sorts of theories why. One is simply it's month end and quarter end, so and financial year end as well for Japan. So just a bit of rebalancing of portfolios. Another is somewhere along the line there's been a bit of a liquidity problem with one of their clients, and they've been forced into making the move. And there are reports that this is related to Chinese ADRs. Chinese stocks basically sold through the US share market. Companies like Baidu and Alibaba and Tencent, although none of those actually suffered too badly on Friday. But holding Chinese stocks might become problematic if tensions do ratchet up between the US and China. And let's remember what Joe Biden said about China when he gave his first press conference last week.
I see stiff competition with China. China has an overall goal, and I don't criticize them for the goal, but they have an overall goal to become the leading country in the world, the wealthiest country in the world, and the most powerful country in the world. That's not going to happen on my watch.
So the president talking tough. A response to that perhaps was when we saw Taiwan reporting that Chinese planes flew into their airspace on Friday. So the tensions with China might be ratcheting up a little, perhaps more than they did even with Donald Trump. Actually, it's very different this time because that was all about trade. This is much more than that. But on trade, Biden did say they're just going to ramp up their investment to compete against China.
We're going to invest in medical research, cancer, Alzheimer's, diabetes, the things, industries of the future, artificial intelligence, quantum computing, biotech, and we're going to make real investments. China is out investing us by a long shot because their plan is to own that future.
And we'll get more from Joe Biden on this. His $3 trillion, yes, investment plan coming in the middle of this week. $3 trillion because, we're all going crazy, printing money right now. So compete rather than block trade seems to be the approach. But then also forming an alliance to challenge China on its human rights.
We are going to hold China accountable to follow the rules. whether it relates to the South China Sea or the North China Sea or the agreement made on Taiwan or a whole range of other things. And the third thing, and the thing that I admire about dealing with Xi, is he understands. He makes no pretense about not understanding what I'm saying any more than I do him. I pointed out to him, no leader can be sustained in his position or her position unless they represent the values of the country. And I said, Mr. President, as I've told you before, Americans value the notion of freedom. America values human rights. We don't always live up to our expectations, but it's a value system. We are founded on that principle. And as long as you and your country continues to so blatantly violate human rights, we are going to continue in an unrelenting way to call to the attention of the world and make it clear what's happening.
So US-China relations could be in for a challenging time, couldn't they? Maybe it's going to be the US and much of the rest of the world versus China. So does that make China a bit of a risky investment right now? Maybe that's adding some volatility to the markets. And let's remember, China has grabbed extra market share during this whole crisis because, they got out of it quicker, so they could grab more market share. They have much more of the world trade than they had going into it. So now maybe it is the time for the rest of the world to catch up. Maybe now they're going to grab some of that share back. So that could impact China's growth prospects. And then, of course, for the short term, we've got this problem.
6 days on, and the fear is that the ever-given blocking of the Suez Canal will lead to global shortages of oil, gas and goods. And it's not just what's on the vessel itself, although that's significant given it's one of the largest container ships in the world. But it's what's on the other 300 or so vessels treading water at the entrance and exits of the canal, as well as those stuck in the middle.
That's a report from Al Jazeera there. And look, yesterday, attempts to refloat the vessel at high tide failed. So now Egypt has ordered that the cargo should be lifted from the ship to lighten the load. And look, there's tens of thousands of containers on that ship. And how do you offload it in the middle of the desert? It's going to take ages to do that. And all of this, of course, is showing how dependent we are on world trade. By the way, I love this. A friend of mine posted a picture of a narrowboat blocking a canal in the Norfolk Broads. That is about as bad as it gets here. That's our equivalent, although, our trade, I guess, is permanently blocked in traffic jams on the M25 or trying to get up the M6, isn't it? That's bad enough. But is China a safe bet for investors? Perhaps their recovery has peaked. I mean, there are the geopolitical tensions. There's the desire by the US to compete with the rest of the world, and Joe Biden is now talking about the Western equivalent of a Belt and Road Initiative to compete against China's Belt and Road Initiative. And then you've got the realization that this one tiny stretch of water is the single point of failure that so much of the trade that we carry between China and the rest of Asia and us in Europe and the United States are all reliant on. So you can see why people perhaps are wanting to bail out of Chinese investments. But that big sell-off on Friday happened while shares were generally rising. There was a lot of enthusiasm because we're seeing vaccine programs being fast-tracked in the United States. Infection numbers are also falling. Different story for Europe, of course. And if you want an example of stock rotation, stocks that will do worse as things get better for us, just look at TV companies, because we're not going to be glued to the couch with our eyes glued to the square box. Viacom CBS fell 30% on Friday in the United States in one day, down below $45. They had been up over $100 at the start of the week. So Friday was just the nail in the coffin for what had been a disaster week for them. And Discovery also fell almost 30% on Friday and down from $77 to $41 in a week. Now, that is not good news for, in the UK, Andrew Neil's new venture, because that was supposed to start this month, by the way. That's clearly been delayed. GB News, which we know is going to be as far right as Ofcom will allow any news channel to be. It's going to be Fox News Lite for the UK. That's backed by Discovery. So let's hope they don't need to raise new capital, because it's just become twice as hard and twice as expensive for them with that halving of their share price almost. Something else GB News might want to keep an eye on. They're going to use cloud-based software to play out their news. So all resources are basically centralized on a server somewhere. It's going to be a virtual server. So rather than just it all sitting in a studio complex somewhere, they're using a system from a company called Red Bee. But another cloud-based system created problems for Channel 9 News in Sydney, Australia yesterday.
Nine CEO believes the network has been the victim of a cyber attack. It's affecting the network's ability to produce its news and current affairs content.
And that cyber attack has impacted our ability to go live to air on the Today Show this morning. So a lot of our Today Show, weekend Today Show fans were unfortunately unable to see that show.
Emails and editing systems have been hit. The hope is that the Today Show tomorrow will be broadcast normally.
And there are suggestions that it was a hack by the Russians because the TV network is getting ready to broadcast an investigation into Vladimir Putin, looking at Putin's deadly campaign of chemical assassinations being waged against his enemies on the streets of Western countries. That's the description in their TV guide, but we all know that's happening. That's surely not a scoop for Channel 9, but they believe that Putin is trying to silence them. Anyway, whatever the reason, hackers brought their network down, stick it in the cloud, and, you make it easier for people to pull it out of the cloud. So that's not good news, maybe not good news for GB News as well. So another reason for volatility in the markets. We've got all these cyber attacks, all this geopolitical uncertainty. You add all of that to COVID. How can we make sense out of anything these days? And there is just so much uncertainty. And last week, the Financial Conduct Authority published research which showed that there are now many younger investors taking on much higher risks when trading not just in shares, but also riskier assets like cryptocurrencies and foreign exchange. The FCA reckons that many investors are using emotions and feelings such as the enjoying the thrill of investing and social factors like the status that comes from a sense of ownership in companies they invest in. And they're the key reasons behind why people invest. That's the key reason behind the decisions. Now, last week on the podcast, you might remember I played a clip from MSNBC's Jim Cramer. He was worried that many people have been investing in shares, trying it out, and now backing out of it because they've been burned by it. Part of it, he was saying, was because people had unrealistic expectations of the returns they were going to get, and also they weren't selling on the highs. And I suggested that, if you're new to this game, it's harder to sell than it is to buy because you've got to keep an eye on what's happening, which basically means you've got to be a full-time day trader if you're really doing that, if you're really buying and selling of all the moving parts in the markets. You can't do that if you're a part-time investor. You've got to take a longer-term view. Let's see what Rodney Hobson thinks of all of this. This report, Rodney, from the FCA, puts self-directed investors into three categories. They say there's those having a go, so they'll try. They probably won't spend a lot of money. They might lose a bit out of the experience, but they're giving it a go. Those thinking it through, those are the ones who tend to be from a mathematics or business background. And then there's the gamblers. And it's those that they say are the concern. They're the ones who could really lose out and lose a lot of money on this.
A lot of people just don't understand the difference between gambling and investment. And indeed, I had an argument on Twitter, mercifully we kept it civil, by someone who just couldn't grasp the difference. And I think this is a major problem. The point about gambling is that the pot shrinks. For every winner, there has to be a loser, and also the casino or the bookmaker or the trading platform, whatever you're gambling on, takes a cut out of it. So, in fact, there are more losers than gamblers, more losers than winners.
Yeah.
And then you find that people have lost their entire stake, and so they have to start again. Whereas with investment, the pot grows. You invest in companies where they're producing profits, so more money is coming into the pot. There are more winners than losers. So the whole attitude of gambling and investing is completely different.
But you can see that argument you've given there, though, would be a reason why people who would gamble in other ways, like gambling in casinos, would say, well, yes, the house always wins, whereas, let's gamble in the share market instead because it is a growing pot. Therefore, it's a safer gamble. It isn't the point of the fact that they're actually not putting enough attention into it. It's easy to gamble because you're just taking a risk rather than actually falling into one of those other two categories that the FCA were identifying. We're actually thinking about what you're doing.
Yes, this clearly is a problem. You think that gambling's, yes, the house always wins. So you think, let's go in for shares and we'll gamble on those because the pot grows. But the problem is this, that if you gamble on the outcome of a football match, you're not playing football, you're not even a footballer, you're not even a football fan. You're gambling. You're a gambler. Now, if you gamble on shares, that doesn't mean you're an investor. It means you're a gambler. And the whole attitude is different, and this is what people don't understand. And they do see people making money out of investing. And one of the things that draws people into gambling on investments is you get people who say, I made £30,000 a month out of contracts for difference, which is effectively not investing, it is gambling on the movement of share prices. Now, if a poker player came up to you and said, I make a living out of playing poker, I'm a professional poker player, do you fancy a game? Well, you'd run a mile because you think, well, I'm not playing against somebody who always wins, he's winning off me. But when somebody says, I make money out of gambling on the stock market, and we're talking gambling, not investing, then somebody else must be losing. So if some people are making large sums of money, it's a warning not to do it. Yeah.
And what about that point I made that, people are taking, these gamblers are taking a short-term view, which, I played a clip from Jim Cramer last week from MSNBC talking about all these people who were piling in, but and then getting with these unrealistic expectations. They were seeing the share prices go up. They weren't ploughing out of them, and then they get disillusioned when they see the price going down again because they're playing a short-term game. And I guess that's what these gamblers are doing, isn't it? They want to get in and get out again. To do that, you really have to know what you're doing. And as you say, most people are very unsuccessful at it.
Yes, you need to know what you're doing. That's absolutely it. And if you're good at short-term investing, you're fine. Go ahead and do it. I'm not stopping anybody. I always say, if it works for you, it works for you. That's fine. But if you are thinking of making short-term rapid gains and then don't take the game when it's available, well, then you're not actually staying true to what you're actually going in for. No. So that certainly isn't going to work. If you're hanging on when the shares peak and start falling again, then you're becoming a long-term investor. So you're messing up. You're still getting confused between the two attitudes towards buying shares.
So if you are going to take a gamble, I guess it's okay to do a bit of it, isn't it? If you know the risk that you're taking. So, for example, I'm looking at Deliveroo this week. I'd be interested in your thoughts on this. But there's a chance, isn't there, to take part in their IPO if you're in early enough and lucky enough. That's a gamble, because I can come up with a list of reasons as to why they might do well, but equally I can come out with a whole load of reasons why they won't do well. Like all it takes is their drivers to demand more money, for example, and their business models probably fallen apart. So for me, it's a bit of a punt. But I'm thinking, well, okay, there's a bit of money. I know how much I can afford to take a punt on that, and I think that's it, isn't it? When you're investing, there's no such thing as certainty, and if you're going to look at higher risk ones, make sure it's money you can afford to do without.
Yes. No, I personally don't invest on IPOs. Share market floats aren't for me. Once upon a time, when it was very hard to price floats, then they often tended to be underpriced. You could often get in and make a guarantee pretty much to make a profit.
Always.
The shares would tend to rise.
Yeah.
Well, now it's all so much more sophisticated. These things are pitched at pretty much the price that they can get them away, and they're pretty much a realistic price. Your chance of immediate gain is pretty nil. But if you're good at spotting IPOs and spotting the companies coming to market and you make money out of it and you do well and you're good at spotting the good ones, fine, I'm not stopping you. I think it's a perfectly legitimate tactic. I won't be buying Deliveroo. I notice that a lot of funds are shying clear of it, and the waters have been muddied a bit because we've now got greater rights for the people who do deliveries. I mean, Uber, for example, are now having to pay their drivers holidays and sick pay, and Deliveroo may be walking into this same trap. So there is a danger there. There's a danger there. This won't go as well. And
You've just talked me out of it. You've just completely talked me in 30 seconds. You've talked me out of what I was going to do this week. So thanks for that.
you just read what's going on? Because a lot of investment funds are saying they're not taking part in it.
Yeah.
And that's a real warning sign. These shares, I mean, I welcome the idea that ordinary investors should be allowed to take a stake in an IPO. And they often are shut out of them. But when all the shares are being dumped onto the ordinary investors, you start to think, why are the professionals avoiding it?
Yeah. So getting back to this idea of these people who are taking risks, perhaps without realizing it all because they're enjoying the joy of the chase and they're getting an adrenaline kick from it. I mean, how do we stop it happening? I mean, we can't tell them they can't do it. We can't make it harder for them to enter the market because that is, it's a very elitist approach and we seem to have moved away from that. So that's got to be a good thing. But is it a lack of awareness? Do we need to educate people more? These people who could lose large quantities of money? Or do we just say, well, that's it. It's their fault. It's the consequences of treating it like a gambling casino.
Well, we're talking about regulating the whole concept of gambling, which we've cut down on advertising. And I think that what we do need is clear warnings to people about this kind of investment. But for me, people will learn. If people learn by losing money and they realize that this doesn't work for them, or they've learned a valuable lesson in life. I'm sorry to sound a bit cold-hearted about it, but I feel much more strongly about cases such as Neil Woodford and London Capital and Finance, where people thought they were investing in properly regulated funds and have now found that the regulations on that side of the equation have fallen very badly short. And I feel much more strongly about the people who thought they were making solid investments and now found that they were let down badly by the regulator. In this case, it's a different regulator, it's the Financial Conduct Authority. But they have a much greater grievance. If people are trading freely, and any stockbroker will make you put the money up, so you've got to have the money to lose in the first place. It's not as if people should be going into debt over this. If people know what they're doing and they're willing to take the risk, then I don't think it's my place to stop them.
Yeah. So that Neil Woodford case is interesting, isn't it? Well, we'll come back to that in a second. Just before we finish on these individual investors, what happens where you've got a situation as we did with the Robin Hood app and the GameStop shares, which was really driven by a whole lot of people on Reddit saying, yes, get into this, which was actually more mob rule, wasn't it? Trying to take down, well, they were told, that they were trying to take down hedge funds, really, to try and stop short selling. But of course, more fool them because they fell for that line. So
I'm afraid so. I'm afraid you have to learn the lesson in life that if you stand in front of tanks, you're likely to get blown out of the ground. I'm afraid this is it. I mean, just to decide, but this is all part of this, the demon hedge funds. They're all nasty, they're the devil, and so we must stand up to them and teach them the lesson. Well, no, hedge funds actually provide liquidity to the market. They're buying and selling, so that if you want to buy and sell, you've got other people there who are trading. It's a great thing that we have hedge funds. Yeah. It's not a case of them being they're just other investors like you. They just happen to be bigger.
So liquidity was a big part of the Neil Woodford problem, wasn't it? I mean, not only was he putting it into risky investments, but their investments weren't easily converted to cash. So investors did want, if they were concerned, if they wanted to pull their cash out, there wasn't enough liquidity in. Yes, in the fund. I mean, with banks, we insist that obviously there's enough liquidity sitting in banks, so surely it should be the same case, shouldn't it?
Yeah, they should have been. The thing is, there are two types of fund. There's one where you all pile in at the start, and that's a fixed amount. That's a closed-ended fund, and investment trusts are closed-ended funds, so that if you want to sell your stake, you have to sell to somebody else who's buying in. The pot in the fund stays the same. Now, what Neil Woodford was running was an open-ended fund. This was one where if you bought in, you you put money into the fund, and if you wanted to withdraw, you took money out of the fund. In other words, the size of the pool went up and down. And unit trusts, as they used to be called, or open-ended funds, are ones where the pool can shrink or expand, depending. Now, if a lot of people try to pull out of the fund at the same time, then the fund has to be able to sell some assets quickly in order to convert into cash and pay that cash out. So the investments that Neil Woodford had, which were not easily realizable, not easily sellable, were completely unsuitable for that fund. But the regulators didn't seem to bother about that sort of thing. That's what the regulators should be looking at, not stopping people from investing and learning from their mistakes.
Makes perfect sense. All right, very quickly, because I'm sure this one's, I mean, there's going to be a lot of, I don't know, how does that end? Because there's going to be a lot of people obviously demanding money. Who pays out that money? I guess it all, because he's not going to be able to pay everything. I mean, people lose out, but it's no fault of their own.
Yeah, well, I'm afraid that's what's happened. And that's why I have greater sympathy with these people, because they thought they were being sensible. And yes, they do get cheated. And the same thing has happened, an even worse scandal for me, is the London Capital and Finance, which was a regulated company, and so got the fig leaf of respectability from being regulated, but it didn't actually carry out any regulated business. It was carrying out a pile of unregulated business, putting money into bonds in small companies. Small companies are more likely to go bust than big ones, and it was promising large rates of return, and people fell for that because they thought this was a regulated business, and they found out that it wasn't regulated at all. And that's an even worse scandal to me than Neil Woodford. So let's get the regulators working on that sort of thing, regulating the people who are offering these investments, or gambling, whichever it turns out to be, and stop trying to regulate the people who put their money in.
Yeah, absolutely. And meanwhile, education really, isn't it, is the other side of the coin. For those people who are investing, we've just got to make sure there's, good education programs available for them, I guess. Look, very quickly before we go today, so a couple of things. One, DIY. It seemed like it was the big winner during lockdown, didn't it? And we had good results because we had nothing else to do. We might as well do our house up. Good results from Kingfisher, who owns B&Q. Look, we had massive queues all through last year outside B&Q stores. So no surprise there. I wonder how long it's going to last for, though.
Well, that's the big question, and that's what I'm afraid I can't tell you the answer to. And investors, I mean, normally if I can make a tip on this podcast, I will do so, but I can't tip this because you have to form your own opinion on whether this will go on. I mean, it is thought that a whole new generation of people have started doing the DIY at home and will now be hooked on it. And if that turns out to be true, then Kingfisher will prove a continuing good investment. And
I've got a counter theory. I've got a counter theory to that. There's been a whole load of botched DIY jobs last year, and wives have told their husbands that they're going to go nowhere near the DIY store from now on, and they're going to get someone who knows what they're doing. I think there's going to be a lot of that going on. But still, I mean, Travis Perkins, they're going to spin off Wix. That's their hope. So obviously they see there's an opportunity in this space to grow more.
Yes, Travis Perkins has been trying to spin off Wix for the past 3 years, and things have never looked right. But now they suddenly think, yes, this is the moment. And at least that's something where you won't be buying the Wix shares. What they're going to do is for every share you own in Travis Perkins, you'll get one share in Wix, so no money changes hands when in the flotation. But yes, you do have to wonder if Travis Perkins is dumping Wix just at the top of the market. Yeah. And then Travis Perkins figures will be flattered in years to come, and they'll have got rid of the Wix bit that could well sink. So it's a warning to everybody. Just be careful before you decide what you're doing with it. Yeah,
because they think everyone, following my theory, they think Wix isn't going to do that well because DIY becomes a thing of the past that we all tried during lockdown. We get the professional tradespeople on board and they all go shopping at Travis Perkins. So maybe that's... Yes,
I mean, the other thing is we tend to do DIY if we think we're staying in the house we've got.
Yes.
If we now see more people moving as you're able to go and view houses and this pent-up demand comes through, you may find that people start saying, oh, well, I'm not doing the DIY anymore. I'm going to move house. It's cheaper and it's better.
And that would make perfect sense, wouldn't it, that we did it up while we were at home during the lockdown. Now we're ready to sell. It could be an interesting 6 months on that. Look, very quickly, we've only got a few days, haven't we, to before we run out of the end of the year for our allowances for ISAs. So what do we do? Because if we haven't spent up our what is it, 20,000 we can put in, isn't it, each year? If we haven't done that, do we get it in there somehow, or what do we do with it?
I try to warn people, don't get caught at the last minute trying to scramble into an ISA. I did it once and I learned my lesson. I didn't do it again. It took me several years before that showed a profit, although it did eventually. So don't scramble at the last minute. But if you haven't put money into your ISA and you want to do so, you've effectively only got till Thursday because the Easter weekend is knocking out the last days of the financial year. What I would suggest, if you've got a stocks and shares ISA, is move the cash into your stocks and shares ISA, which you can do before the year end. You don't actually have to invest it.
Right.
You don't actually have to buy shares.
Just have it there as your funds ready to use. Yeah, makes perfect sense.
So I would recommend doing that rather than try to buy something just for the sake of buying it.
Yeah, and look, even if you decide afterwards that you need that cash, you can always pull it out. I mean, you won't get the benefit of having it sitting in your ISA account, but I mean, you know, if you've got the cash there, you might as well.
Absolutely right, yeah.
Might as well do it. All right, very good. Very useful as always. It's always great fun talking to you, Rodney, and we take a lot out of it, so it's good to talk. We'll get you on again very soon. Thank you. There we are. That's Rodney Hobson. Now, finally, the newspapers this morning. And for once, almost every paper is following a different story. The FT covers the potential collapse of Liberty Steel after the funding crisis that was brought about by the collapse of Greensill Capital. As ministers snub a bailout plea, the headline, Sanjeev Gupta launches last-ditch bid at raising cash to save the GFC empire. And also, they have the story about the potential for more sell-offs today. After the fire sale on Friday that we were talking about earlier, an investment firm, Archigas Capital, was behind what actually happened. They say it had large exposure to Viacom, CBS and several Chinese technology stocks, and that was hit hard when Viacom stock started to tumble last week. So that's what started it. Then there was a margin call which brought about the collapse. So that's what's happened. Will there be more of it today is the question. That's the FT. The Independent has a story about Len McCluskey warning over Sir Keir Starmer. The union boss says Starmer's Labour has lost identity and it's going to suffer at the polls without clear direction, presumably the direction that Len McCluskey would like it to take. The Guardian headline, police chief admits wicked race crisis hinders fight against crime. Martin Hewitt, who's the chair of the National Police Chiefs Council, says the force's legitimacy in black communities is so low that it is damaging the effectiveness of law enforcement in those areas because confidence in the police in black communities was 20% lower than it was in white communities, he says. And also the police on the front page of the Times today. Cover-up of abuse by pupils, says Chief Constable Simon Bailey, who is telling the Times that schools have covered up sexual offences to protect their reputation, and a culture of misogyny and sexual harassment has not been challenged in some schools, he says. Also there, a story on Gupta, with the PM rejecting £170 million bailout. That would £170 million. That would be about £35,000 for every job saved if Liberty Steel was to collapse. Doing some quick maths there. Is it worth it? And raking up the past, Bashir showed Diana fake Tiggy abortion bill. An exclusive in the Daily Mail saying Princess Diana was allegedly tricked into giving that famous Panorama interview after Martin Bashir showed a faked abortion receipt for the royal nanny. It says that claim is amongst evidence given to an inquiry into the BBC and Mr. Bashir. And the Daily Telegraph headline, scrap use of BAME label. Grace Label tells Johnson. They say the acronym is outdated and unhelpful. So what term do we use now? We have to keep up, don't we? Soon it'll be derogatory to use the term BAME. So be careful. I told you every paper is very different this morning, isn't it? Something for everyone today. The Eye is leading with a warning in variants or of variants as lockdown eases today. Because today we can now meet people outside for the first time, but recovery is still threatened by a further wave of infections and strains that could be vaccine resistant. Oh, joy. Can you imagine if the drugs don't work? We're all just going to go gaga. A slightly more positive slant on the Metro, though. Jabby Monday. 30 million have had their first injection, on target for the second dose. Rule of 6 and sport back today, and even the weather's good. Maybe we should leave it on that positive note. Well, actually, no. One step further, the Daily Star. A picture of a pot-bellied man in budgie smugglers with a large overhang, even larger than my stomach, hangs over my waist. Bring in on the budgie smugglers, it says, with a long, hot summer forecast. Well, that is a positive note to leave it on, isn't it? Back tomorrow morning. The importance of data on driving your business online. We're going to look at that tomorrow. See you in the morning. I'm Phil Dobbie. Thanks for listening.
It's the Business with Phil Dobbie. Listen online at its.business or wherever good